What is good, Tesla family? It's Ray J back with another video, and in this one, I'm going to be talking about the one and only Tesla stock and break down some very important information about the markets and how this could actually cause Tesla to come down a bit in the future. Now, I know a lot of people don't like to hear this, and I don't want to just spread FUD or do anything like that, but I need to tell you guys the truth about what's happening in the markets and why on earth we could see more potential downside given all these signs. Now, remember, the long-term future of Tesla is still very amazing. So this opens up a big opportunity for lots of people to go long and to buy at those lower prices. So I want to break down what could happen to Tesla's share price, why on earth the markets are not in the best of states, and what could actually play out for the future. Now, before I break anything down, before I compare the current market with 2008, I do have to mention a couple of things before starting. Firstly, I'm not a financial planner. Don't take any of this as financial advice whatsoever. And also, if you guys can, please smash the like button if you want to see more videos like this. It not only benefits me, it benefits the entire Tesla community as a whole. And the last things, if you guys can, please check out the Webull link down below and in the description. If you sign up for Webull, the link down below, and deposit any amount of money into the account, you're guaranteed up to 12 free stocks, each worth up to $2,000. And the best part is, any of these 12 free stocks could be a free Tesla share. It's a limited time offer. The offer ends in just 2 weeks. Check it out before they run out. With that out of the way, let's get on with the video. So, looking at the market, I must note something very important. According to many sources, it has been noted over the last few decades the average bear market will see a 35% drop in the SPX or the S&P 500 and many futures out there. We actually have many sources that confirm this. Now, currently, it tends to last about a year, maybe about 12 to 14 months, sometimes over like 16 months. And right now, seeing that a recession is almost inevitable at this point, and we already know that we've been in one, but different people are changing the definitions. I'm not really too worried about that. We're currently down at 24% from the all-time high when SPY was rallying that high. What's interesting about this is when the bear market started is we still appear to have more potential downside in the markets, and I'm not liking what we're seeing in the SPX and the NASDAQ. They tried to push up a bit just recently, and they got rejected, and we did see a lot of red, and this is not the best of signs. So right now, the market is being driven on fear. People are panicking, and we are seeing a lot of capitulation continuing to increase in this market. So, what does this mean for the future? What could end up happening? Well, one thing we can actually use is the VIX to tell us a very big sign as to what is going to go down. If you don't know what the VIX is, just a quick summary as to what this thing is. Right here, you could see the CBOE Volatility Index, also known as the VIX. It's a real time market index representing the market's expectations for volatility. And basically, to make this simple, it measures the level of risk and stress or fear in the market. So when the market goes down, the VIX tends to go up. They tend to be inversely correlated. Generally, the VIX rises when stocks fall and declines when stocks rise. So, with that said, going back to 2008, we have 2008 on this side, and we have 2022 on this side. And you will see during the 2008 crash what happened to the VIX. It went from about 18 all the way up to 89. So there was lots of fear, lots of stress, lots of risk in the markets, and the market crashed during that time frame. But when you look at them side by side, there are some similarities between the 2008 pattern and what we're currently seeing on the VIX right now. I actually took a screenshot, and let me actually use this one instead because I think you could see it a little bit better. So what's interesting about this is starting off, in 2008 we had this big spike on the VIX. We come down, have a small push up followed by a big drop, but then in our market we had a similar move, but then we got a big push to the upside before we came down. Now we have this similar formation on both sides right here. I'm sure you guys could see the yellow rectangle on each of them. Very similar. And then after that, we have this one right here. Once again, a double top like formation followed by this like higher bottom. This forms kind of like an inverse George W, coming down even lower. This time in the market, it did not come down much lower. It actually almost formed a double bottom, and we started to see a push up recently. Now, this push up right here is when the market was dropping. And what we are starting to see is the market was coming up a bit, similar to what happened in 2008 before the big crash. Now, the thing about this is The volatility index did have more room to come, and also history is not necessarily obligated to repeat itself. So it doesn't have to happen the exact same way, but this is kind of like a red flag you should be very well aware of, considering the fact that the majority of banks are not as confident in this market. We are seeing the reverse repo going up again, which is a sign that a lot of banks, excuse me, a lot of banks are just like holding on to cash right now. They're not wanting to actually invest much money into different places. They are starting to buy more into like different yields and bonds because the return is a lot more safe than the markets, and there is a loss of kind of like trust in markets when things like this happen. So does this mean that the VIX has to explode in order for us to continue going forward? The answer is it doesn't have to happen immediately, but it definitely can happen. And another very interesting statistic is if you look at the VIX just like this on the weekly, you will notice that during every single major crash that the VIX had, just ignore these rectangles. These are just for example. But going back over the last few decades, what do you guys notice here? You notice we had the 2008 crash. The VIX goes to 89. We had a big drop in 2010. It went up to like 48. It went up to like 48 again in like 2011. Then it happened again around close to election time. No, I'm sorry, like 2015 it happened. We saw this at, what is that, like 52? It came down in 2018 when the markets were dropping. Then we saw a big push up to about 50. Then all of a sudden, we had the flash crash that happened in 2020. It went all the way up to 85 and we dropped really hard and really fast. Then it came down. And we've seen a lot of volatility, but you'll notice we're currently barely at 31. So during every major drop in the markets over the last few decades, the implied volatility index, the VIX, will go above 45, or it like comes super close to it every single time. Now, this time it's currently at 31, and we did not even come close to 45 yet. So this could be a very big red flag in the markets too, a big sign that things are not in the best of states. So I want to see the VIX hit 45 if we are truly going to see that crash, and it does seem very possible for something like that to happen very soon. Now, for as far as like the market goes, as far as this data goes, I'm not going to say that it's going to happen immediately, but very soon it could continue to happen as the Fed is trying to cause a crash because they want some blood for the short term so that the long term could be a lot better for us. And their main obligation is to get rid of this high inflation. Now, looking at some other data, we can see right here that hedge funds are actually short at record levels. They're shorting like crazy right now. This means that they know something. They know it's very likely the market's going to be coming down. And right now, the SPX, the SPY, they're very close to their lows for the year. Once again, not looking the best. What else is interesting is looking at the credit default swaps market. We could see big companies out there such as like UBS and also Credit Suisse. We're seeing their credit default swaps spiking again. Once again, an all-time high, even surpassing the 2008 financial crisis. What this means is these credit default swaps are kind of like an insurance to help mitigate the risk when these loans are being taken. Now, the problem is when they start to go up like this is a sign of a lot of risk for these banks to kind of default on their debt and have a much harder time at paying off this debt, similar to 2008. Now, I'm not trying to spread fear to everyone and say it's the end of the world because it's not the end of the world. We know even when 2008 happened, eventually the stock market recovered. Everything will recover, in my opinion, at least for the most part, depending on if things do end up getting delisted or not. As for Tesla, what on earth does this mean? Well, a couple of weeks ago, I made a video and I talked about the Wyckoff accumulation schematics. I think I have two charts right here. We have two variations. All right. In the first schematic, this is actually the first one technically. You have the sell test in phase B, a nice push up during phase B of the schematic, followed by a big drop into phase C, leading to the spring, the absolute bottom, followed by a big bounce and recovery. That's the first version. The second version is if, like, a stock, for instance, or whether it's Tesla or not, if they truly made their low already and they're not going to make a new low, what tends to happen is they push up, but they do come down a bit during the last point of support in phase C, and they get a big recovery bounce from there, approaching phase E. Now, for Tesla right now, we are coming down pretty hard as we are seeing this big distribution phase. So it's like a distribution schematic. We don't know yet, which is most likely going to happen. But if the market were to crash, if the market does end up crashing, which is very possible, very likely to happen very soon, it is possible for us to see this schematic play out, which means right here a new low could actually be made. So I was talking about how historically this is actually kind of unusual because historically during midterm elections, the market tends to actually rally. We tend to see that big recovery, but right now we're not seeing signs of it right now. And this is not a good sign for whichever party is in power. And I'm trying to remain nonpartisan when I make these claims, no matter which party it is, no matter which color, which party it is, it does not matter. Any party would be in trouble if this was going on. OPEC is actually decreasing their supply production rate of oil, and that's not a good sign for the US. Gas prices are starting to go up. I mean, it's not looking good in my honest opinion. So, with all this going on, with us potentially entering an earnings recession relatively soon, this in turn may have a negative effect on Tesla. So, the one of the key zones I mentioned in my previous videos is I was talking about this low that Tesla made in, I think this was 2021. Yeah. So this low right here, if you use the Fibonacci tool right here, this Fibonacci extension, you will notice that 200 to 180 is a very key zone for Tesla. Now, I'm not guaranteeing it's going to come down that low, but if this thing does get a break below 217, it's very possible we're not only going to retest this low we made previously in the low 200s, but it could come to this zone right here. Very, very possible. Now, in my honest opinion, as a long term Tesla investor, I'm not really worried where it really drops to. I don't care if it's like 217 to 206, 200. To me, this is a killer deal for the long term. For the long term future, seeing that this thing could still go to the thousands as time goes on, it's still a very, very great deal. I'm going to be dollar cost averaging. I don't even consider this a bad thing. I think it's a very great opportunity. Not financial advice, by the way, but I just wanted to make this as clear as possible. So for the markets, more downside does seem imminent, especially considering the statistics that during the average bear market, the market often drops 35%, and we're currently at 24%. So do what you guys have to do. Please be ready for this because even though this could be hard for a lot of people, I have all the sympathy for you guys. I understand how hard it is during times like this to afford grocery bills and gas and things like that. But I also need to note that this is a big opportunity, an opportunity to buy stocks for cheap and to create immense wealth. Remember, a lot of rich people, they become very wealthy during these recessions, during these market crashes, during the big recovery phase. The market is not just going to crash forever. Recovery is eventually going to come. You have to be ready for that. Anyways, thank you all so much for listening. Nothing I say is ever financial advice. Please do what you have to do. Be ready, and I hope I brought some value into your guys' lives. Enjoy your weekend. Take care, and I'll see you guys in the next one. Tesla to the moon because the long term future is still incredibly bright despite everything going on. And peace out.